Welcome guys to ALD7.0, and I hope you are able to see my screen, and this shows quite a few number of names which we have discussed in the previous ALDs. So what is common in that? Anybody can guess? What is common in these names? Yeah, one is old ALD. Yeah, all were Dhamaka. Great, Rashmi ji. Yeah, most of these names have worked out too well actually over the time, and I've chosen these names so that you are aware that we discussed so many names. Possibly we have gone to 70, 80 names over the 6 ALD sessions, and out of which only few have come up with the good dhamaka basically. So a lot of them have failed. That is the key message. Lot of the discussions that we do might fail. So don't just jump in by looking at the name. Try to understand the business behind it. That is very, very important for this ALD. And as we move forward, I hope you have gone through this kind of conditions also. You might have seen, okay, I have identified some of these, but I missed it. It ran away, right? This kind of thought would have come to your mind by looking at these names. What I would say is possibly you did not study them or understood them. You must saw it because the name came here or name came in the social media somewhere, and you are regretting that you could have bought it. But believe me, if you have done with just the names, you would have sold it like within 10-20% returns or 50% returns at max. So you have to understand most of the time a stock runaways 10x to 50x also. And you need to see where it is today in its journey. And riding some part of that journey will make you wealthy. That is more important to understand. So a few examples was I can tell you one or two of my good picks. 2020, I saw them because I just saw them on the social media. I did not study them. That is Avantel at 4 or 5 rupees, HBL at 13 to 15 rupees. 2022, it took me 2 years. I went back and understood them and bought it. When I understood them, it gives me conviction to even buy them at 4x or 6x the original price of 2020. So that conviction can only come if you understood the business. If you don't understand the business, then you, even if I bought at 5 rupees, I would have exited at 10 possibly. That's where I'm coming from. So to overcome the price bias, you have to understand the business. Now imagine Avantel, despite missing at 5 rupees, I bought at 15. Still it is trading at 10x. HBL missed at 13, bought at 80, 90, trading at 900, 10x. So because I understood the business, I was able to carry it till this time. Now, 2025, what we should do? I'm not worried about what I'm seeing today or what I'm going to miss. I will be more focused on and turning more rocks to understand and looking for the gems and trying to sit on my ass if the thesis fits for me. This is what I'm going to do in this ALD. That is very, very critical. Now, two important points before we kick off with Ankit. Peter Lynch says the same thing. The person that turns over the most rocks wins the game, and that's always been his philosophy. And Charlie Munger is saying investing is where you find a few great companies and then sit on your ass. So what we are trying to do in ALD, which is Alpha Learner Day, we are trying to see as many as rocks and see which can turn out to be gems in this overall. So going back to the first slide, we might have discussed 70, 80 names. We might have got maybe 10, 15 out of this. That is the point. And can we sit on that once we found them? That is the key here after ALD. Okay, so welcome to ALD7 to all of you. And the sectors or the rocks which we are going to turn towards this sector would be coming from metal, pharma, IT, power, education, automotive, chemical, so many sectors people are trying to cover in this ALD. Thanks to all the participants who has put their hands up for doing this. And just before going last slide, which kind of rocks to be turned? When anyone is presenting and when you're building your own thesis, you should start looking from these points. Whether the presenter or the company which is going to be presented, is that company catering to the long-term need of the industry? Is it an evolving landscape? Is it expanding landscape? What is the scope of opportunity? Can this company become big or not? Is promoter hungry or not? Is the fundamental ratios reasonable or not? Is it doing a simple thesis which you can understand? There are no complexities which will push you to not understand it later. So the thesis should be as simple as that. Risk, do you understand and acknowledge? And if you take a bet, you should be winning it. And sometimes the thesis doesn't work, then you should not lose much. I think with this kind of framework, if you go and listen to the sessions, I think definitely you will gain something out of this ALD 7.0. And we have good set up a good benchmark over the ALD1 to ALD6, and let's take it further. And as I said, alpha affairs. So affairs cannot be random. It has to be very, very in a focused way, which rocks we are going to be turning. So I will hand over to Ankit and let's start our ALD 7.0. Ankit, I'm stopping my screen and you can start sharing it.
Yeah, just give me 1 minute.
Yeah, so our first presenter would be Ankit, and he has taken his hands up and he will be the torchbearer for ELD 7.0. He's presenting two companies this time. I'm really happy that he has taken up this responsibility.
Okay, is my screen visible?
Yes, now it is visible.
Just a second. I need to minimize this. Yeah. Good morning, everybody. A very good opening speech, Puneet bhai. And so in this, today I'm going to present a company named Ascent Microcell. As you can see in the slide, when everybody is digging for gold, it's good to be in the picks and shovel business. Puneet also mentioned it in his opening speech. So by gold, what I mean here is, gold here is basically the pharma industry, growing and booming pharma industries, the CDMOs, be it branded formulations or generic drugs, anything. And SN Microcell is one of those companies which is basically providing ingredients for that, for the whole the pharma sector. Okay. So I will just give a brief overview about the company. The company started in 2012 as a dedicated manufacturer and trader of pharmaceutical excipients. They have two plants, both are in Gujarat. Pirana, which is in Ahmedabad, they have a 2000 MTPA capacity there, and it is 100% utilized. Then there is a Dahej plant with 7,200 MTPA capacity, and that also has near full capacity. Okay. Uh, these are some of the ratios for the company. If you, I just need to hide it. Okay, so you can see the 5-year sales growth is around 15%, but the profit growth in the same period is around 50% CAGR. Okay, and this is the next slide. Uh, so basically, what are for pharmaceutical excipients? Okay, this the image which you can see here, this lays out clearly in a layman terms what are excipients basically. So if you look at the middle picture, that is the tablets. Okay, tablets consists usually of two parts. One is the API, which is the active pharmaceutical ingredient. API can be of different varieties, but in every API you need a substance called the excipients, and the role of that excipients, is basically to stabilize the drug, make it more safe, make its texture better, and improve the taste of the medicine that you're consuming. And then it basically goes into every single medicine that you take. be it a painkiller, be it an oncology drug, anything. It goes into every single medicine. So we'll take the next slide, just a minute. Yeah. So microcrystalline cellulose or MCC, that is the primary form of excipient. Okay, around in India, especially 80 to 90% of the excipients is MCC only, which is the microcrystalline cellulose. Okay, the rest is the basically derivatives of microcrystalline cellulose. Okay, and as I said as I said just now, that it is a very invisible product because it's mixed with the API and to form a tablet, so you can't see it. Okay, but you consume it almost every day in some or the other form. All of us consume microcrystalline cellulose every day, so it's basically like an FMCG product only. Okay, it's used by everybody. This is the rough gist of how the manufacturing of microcrystalline cellulose is done. Basically, what happens is company imports wood pulp from countries like South Africa, US, Israel, Indonesia, and that wood pulp is is mixed with hydrochloric acid, and then it's steamed. After that some mixing is done, and it is put in a reactor to do the heat recovery, and then some washing is done, and then drying is done, and then what basically you're left with is a white colored powder. MCC basically looks like a white colored powder. Yeah, okay. There's nothing else. So coming back to SN Microcell, this company has this is the product portfolio of the company. Around 85 to 90% of the revenues come from this first product, which is the MCC, microcrystalline cellulose. All the other products are, the derivatives of MCC only, and they are much higher value than core MCC. The core MCC has a EBITDA margins around 18 to 20%, and these all derivatives products are roughly valued at 2 to 4 times that of the MCC. Their realization are 2 to 4 times higher than MCC. Okay, so looking at SN Microcell, okay, their journey so far and what are their plans going ahead. Okay, so from 2019, in 2019, FY 2019, they had a sales of roughly about 114 crores, and 2024 they closed about 246 crores. So more than doubled. They doubled their revenue in five, more than doubled their revenue in 5 years. Okay, but the main theory here is earlier in 2000 up to 2018-19, their EBITDA margins were in the range of 7 to 8% because they used to do trading a lot, get the MCC from somewhere else and then supply it. Okay, and what they have basically done is they have started more on their own manufacturing. So that has done is they raised their almost double their EBITDA margins in that period. Now they are operating at 17%. Even if you look at the FY 25 numbers, it's around their margins are around 16-17%. Okay. In all this time, they have maintained a very, very low debt all on and almost negligible debt. Okay. Debt to equity has been maintained by them at a very low levels. Okay. And post the IPO, they IPO'd in 2023, I think. And post the plan of the IPO was for two reasons. They became completely debt free post the IPO. They use some of the funds uh, to eliminate their debt, and they are using some funds to do capex as well. So, if you see across screen, you will find that the cash flow right across the 12-13 year history, they have hardly had any year with a negative cash flow. Almost every single year is cash flow positive, so their so their recoveries is very good in this business, and that allows them to maintain a very high ROE and ROCE. Always it's ROE and ROCE is always in the high teens or even in about 20% sometimes. Okay, and basically coming to the IPO, when they IPO'd, they had a since they were running on full capacity. Okay, if you look at the numbers of FY24 and 25, it's more or less flat as the capacity utilization is complete. So the idea was of the IPO was to do a capex boost into phases and get into more higher grades of MCC, which we saw in the last slide. So basically, right now, they are 85 to 90% of the revenues are coming from this core product, which is MCC, and these are the rest of all are value-added products. So with the new capex, what they want to do is they want to increase their share of value-added products from currently 10 to 15% is the value-added products. They want to go to 20 around 25% up to 25 to 30% in value-added products after doing this capex. So what this capex will do is not only increase their capacity, it will increase their margins as well, and their reliance on their core product of MCC will go down. Okay. So coming to the capex is happening in two phases. The first phase is for the value-added products, which is being established in Nayakheda, Gujarat only. Okay, the first phase will have a capacity of around 2600 to 2800 MTPA. So the current capacity is 9200 MTPA. It will go to 12,000 metric tons per annum. But all of this 2800, will be of value added products only. So their margins in this, in this phase one of unit three would be much higher than their current margins. Around their current margins are 16-17%. Their margins from this new capex will be around 25 to 30% at least. As I have mentioned here, you can see the phase one of unit 3 will have realizations of around 550 to 600 per kgs, and their current realizations are around 180 to 230 per kg. So it will be more almost 2.5x of the current realizations. The revenue potential which they have given for this phase one capex is around 150 crores on full capacity utilization. But the full capacity utilization might take a couple of years to happen. And then they are also coming up with phase two, for which they had recently did a rights issue. Okay. They did a rights issue of around 40 crores for the phase two of unit 3 at Nayak Head itself. Okay. Land was already available, and this phase two will consist of their core product MCC only, but they will more than double their capacity of MCC with this phase two. Phase 2 will add 12,000 MTPA of capacity, and this will be all core MCC products only, which will have again the margins of their current margins. They will do slightly better than their current margins, which is 16%. They should be able to do around 18% with this new capacity. And the revenue potential of this phase 2 would be around 250 crores. So if I look at the FY25 numbers, they ended, I think, around 260 crores of revenues. So after both these capexes are done and we assume the full capacity, then it should be good enough to more than double, basically almost triple the revenues if, yeah, if in the coming 2 3 years they utilize this both these phases completely. So this is a slide on the industry overview of their core product, microcrystalline cellulose, which what they are predicting is for the industry to grow at about 7% CAGR until 2032 and or even until 2035. Okay, this is the global projected growth rate. In India, I think the growth rate can be in double digits at least, because you see a lot of we CDMO companies and CRO companies in India are seeing huge growth. You might have seen a lot of companies which are growing at 20, 25, 30%. And in the last, I think, 2 to 3 years, a lot of many in the CDMO sector, many companies are getting listed. You can look at Windlass, InnovaCaptive, Blue Jet, Sanofi Pharma, Sai Life Sciences. All these companies are growing at 20-25%. Okay. And the growth in India could be much higher than the what the global growth is. So these excipients which we are talking about right now, we only looked at the pharma sector, but the company also caters to other sectors, which include the nutraceuticals, food and bakery, cosmetic and personal care, and even welding electrodes. 75%, 70% of the revenues come only from pharmaceutical excipients. Around 15% come from nutraceuticals and the food and bakery segment. And the rest is all the other sectors combined. Okay, so basically, right now their dependence is very much on the pharma and the nutraceutical sectors. But going forward, they are trying to do some R&D in the other sectors as well, where MCC or its derivatives can be used. The company has a very good global presence. It supplies its products to around 70 plus countries. Their dependence on US is also very little. Only around 4 to 5% of their revenues come from the US. So basically, that tariff issues also, they are not much worried about the tariffs, since only 4 to 5% of their revenues come from the US. In FY25, they had around 53% of their revenues from the exports. Usually, the export ratio is 65 to 35, but in the last 2 years, they have started catering to these CDMO companies. So their domestic ratio has increased. And but the export margins, are generally higher. If domestic is doing around 15%, exports might be doing around 17, 18%. So what the company has basically guided is after their new plant is commissioned, what they have, especially the value added side of it, the phase one, most of the value added products would be catered to the export market only. So the export revenue share, which is right now 53%, it might go back again to 60, 65% at least. This is the roadmap which the company has planned. As I told you, the company is actively doing some R&D to look into other sectors as well besides pharma, nutraceuticals, and food industry. So they are trying to diversify their revenue streams into other sectors like cosmetics, beverages, e-cigarettes, textile, dairy products as well. So, okay, and going forward, since they already have a land available, as I told you in the earlier slide as well, their focus is to increase their share of value-added products, which is currently only 10 to 12%. They want to gradually increase it to, the long-term vision is to do at least 50% in the value-added products. But with with the new facility which is coming around, they should be able to do around 20 to 25% in value-added products. Okay, and they are now actively targeting domestic customers as well. They are diversifying. They are not being reliant on just the big pharma. So, as the Indian market is seeing a high growth in the CDMO and the CMO segments, and even the drug manufacturers, but the generic drug manufacturers, they are targeting new customers in there. Now coming to the two most important slides of this whole presentation, I want to talk to you about a concept called supply chain dominance. I first read about this concept in a book called Capital Returns. Okay, and some people like Soik and Zen Nivesh, they have also written about supply chain dominance in their blogs and on Twitter as well. So what supply chain dominance is, when a company holds a significant market share in any particular segment, or is one of the sole supplier of any critical good or component. What that does is it gives the company a very good pricing power in even good payment terms with their customers. So what it does basically is the company is able to generate high margins and a very good return on capital, because since they have the dominance in that supply chain, they are able to generate a very high return on capital. Okay. Charlie Munger had this saying, go where the competition is either weak or dumb. So I think this excipients industry is exactly that kind of industry where competition is very negligible. There are very few companies in the whole world which manufacture excipients. If you look at a company like Cargill, okay, it was presented in one of the last release. It is one of the only four manufacturer cord sinks in the world. If you look at BSC or even MCX, okay, they basically have 80-90% of the commodity volumes or the derivative volumes that are being traded in India. Garwage High-Tech is another example of a company which has a supply chain dominance. It is the sole manufacturer of some solar films, paint protection films in India. Likewise, TD Power is one of the only two or three manufacturers of gas turbines which go into data centers. Like this, I think Ascent Microcell also has a built-in supply chain dominant in business. And why does it have it? I will cover that in this slide. So Ascent Microcell is one of the only two manufacturers in India. The other is Sigachi and Artemis for some of the products which they are making. The derivatives of MCC which I told you about. They are one of the only two manufacturers in India for those products. And once the unit phase one of unit three gets commissioned, they will be the only company in India which will have some of the grades of excipients which are to be supplied in the market. Accent will be the only company in India which will have those products. Okay, and one of the other reasons is why this kind of business has a supply chain dominance is that this is a very small value of of a medicine. Let's say whether you are making a formulation or you're doing CDMO, the total cost is around only 5 to 7%. The excipient cost is, but it is also very critical. Without it, you can't make a medicine because directly consuming the API might have side effects and its taste might not be that good, the texture might not be that good. So it's a very critical part which goes into the manufacturing of every single medicine that you consume. It goes into personal care as well, in the foods as well. So so companies, the drug manufacturers, the formulations manufacturers, they can't do without it. And since it is only 5% of their cost, what they usually don't change their suppliers very often. Once they are doing business with a Sikachi or an Edison Microcell, they won't look to change any supplier because it's only a small value for them. 5 to 7% isn't a big deal, so they don't like to change vendors. And what this allows the companies like Ascent and Sikachi as well, if there are any some raw material related price hikes, they are easily able to pass on to these companies. Let's say the wood pulp price which they are exporting from the other countries. If there is some turbulence in the prices of the wood pulp, they are easily able to pass on these prices because they have around quarterly contract with the pharmaceutical companies to supply the excipients. And so once the quarter is over, they can easily pass on the any price hikes which are there. And this company also has this business also has high entry barriers because it's so low in the value. And because the pharmaceutical companies don't like to change their vendors, it takes long lead time. So any new company to get many approvals and start supplying products to them. So I do believe that this company also has, just like I mentioned, examples of BAC, Cargill and Garware Hightech and others. This company also has a supply chain dominance. Okay, so this is all the part of my investment thesis. It has a supply chain dominance. Sectoral tailwinds are there. Okay, as the pharmaceutical industry in India is seeing a huge growth, and if you look at the con calls of many companies, it looks like this growth is here to stay at least for the next few years. The company is going into capacity expansion, which will result in margin enhancement as well. Okay, so we are not just looking at a top line growth. If top line goes by 100%, the bottom line might go by 200% because margin enhancement will happen. The valuations are reasonable. It's trading at around 21 to 22 PE on a trailing basis. And because the revenues have basically been flat from last year to this year because of the capacity is fully utilized. The balance sheet is debt free. It's a high ROC, high ROE, ROC generating business, and the company has a rich history of cash generation. Their cash, they are generating. They have always been generating around 70% of their EBITDA into cash. Okay. And it's been something which is historic. It's not one or 2 years in, right? From if you look at the annual reports, right, I've checked the reports from around 2018 to 2019, and from the almost every single year is the high cash generating year. And going forward, they will also increase their share of exports, which will help the margins even more. Now I will cover some the FY25 numbers. Okay, in FY25 they had a capacity of around 12,000 MTP, of which they did volumes from their own capacity rated volumes of 11,500 MTPA. Okay, total volumes of sorry, total volumes of 11,500 MTPA. Out of this, 9,000 MTPA was manufactured in-house, and the rest, I said, they have some trading part as well. Okay, which so if you look at the margins of the peer Sigachi is trading doing margins of around 20%. But Ascent is doing margin 16% because Ascent, what it does is it also buys some semi-finished goods. It processes it and sells it, which lowers their overall EBITDA margins. But once they have these two new capacities, they won't need the to do this trading part. So everything in future, once the phase one and phase two are live, everything that will happen from the in-house only. So that 16% itself will go to 20%, and then the share, as the share of value-added products rises, the margins would expand even more. The EBITDA for last year was 42 crores, and since they have some forex gains and the interest cost is almost negligible, so the depreciation is basically cancelled by some forex gains which they receive. So the EBITDA is basically their PBT. Okay, and the PAT was 33 crores last year. I've done this some assumptive exercise on what their future revenues and and the PAT might look like. Okay, so assuming in FY 28, I have what the management has guided is by FY 28 they should be be able to utilize the full capacity of the coming two plants, the phase one and phase two unit three. One of them is getting commissioned in this month itself, which is December, the coming month. The phase one is getting commissioned next month itself. And phase two will be getting commissioned around June or July of 2026. Okay. So I'm assuming in FY 27 they should be able to utilize around 50% of this both these phases, and in FY 28 or 29 they should be able to reach full utilization. The current revenues, if we take out the trading part, then from the current existing plants, they can generate around 220 crores of revenues. Okay. And phase one should have 150 crores and phase two should have 250 crores. So they should easily be able to do 600 crores at full utilization. And as I told you, since because of the trading part, their margins seem low. But on a general basis, if they don't do the trading part, they should be able to do 18% margins. And in the phase one of unit three, which is the value added products, they should be easily able to do. I'm being too conservative here with 25%. They have actually guided for more, but I'm being conservative with 25%. The margins in phase one of unit three should be even higher than 25%. So basically, the EBITDA which they will be able to generate from all these three units, okay, we would be around 125 crores. And since they don't have any debt, so since still I'm calculating a depreciation of around 10 crores, their PAT would be around 85 crores in FY 28 or 29 at full capacity utilization. And I'm being conservative with this number. The margins could be higher than this. The current market cap is around 750 crores. If they are able to execute on this, okay, and generate this pad, then even at a 20, exit P of 20, you can see an upside of 130%. And if the market is more generous, if we are in a good bull phase, if we are in a good bull rally at that time, it might even get 25 or 30 PE because it's basically a debt-free company and high and basically and since it has a high ROE and ROC, it should get even a higher multiple. So in the bullish case, it's possible that we might see more than 200% gains on the stock. Some of the risk I have covered here. So basically, the biggest risk I see in this company is related to corporate governance only. Since I have not done that much detailed background check on the promoters. Okay, so in micro caps, the main risk is with the corporate governance only, and it's the company is listed only for 2.5 years only. So there's not much information available. They are not doing con calls on a regular basis as well. So, and this is one of the this image which I have shared is from their DRHP when they got the IPO, And what it is tells is that they have related company, okay, which is into the similar business. When the management was questioned regarding this in the con call, they said that you will start seeing, the related party transaction, you will start seeing them going down from FY26 itself. In fact, if I look at the related party transactions in the annual report of FY24 and FY25, then they have already gone down by quite a bit. Okay. The one other risk is that they have a case going on against the National Green Tribunal, who have levied them, some they are demanding a 4 crores against some contingent liabilities. Okay. One other risk is that in the last 2 years, if you can see on the screen, you will find that their receivable days have increased and their total receivables have increased more than their revenue. And the reason for this the company has given is that because they are trying to basically onboard more customers that diversify their revenue streams, they have given some liberal payment terms to this some of the new customers which they have onboarded. Now this is something which we need to track, obviously, because this in the if this continues, then it can hurt the return ratios in the long term. So even the raw material price hikes, they are basically able to pass on most of the times. But if we have a COVID-like scenario, then the raw material price hikes is very high, like 50, 60, 70%. In that, only in those cases, they won't be able to pass on the raw material price hikes. This is the chart. Okay, so as you can see, the company is basically trading at the same level around from when the IPO came around. Okay, IPO came around 280, 290, and current, I think the current CMP of the company is 310 rupees. If we see a good breakout from these levels, we can see a quick 40 to 50% move. The stock is trading above all moving averages even in this market. Okay, it's above all its moving averages and it's about to give a breakout. So that's it from me. If I'm ready for questions, if there are any.
Yeah, thank you, Ankit. It's a good, crisp presentation. So, two questions. I think one of them you have answered is on the related party transactions. And
Yeah.
the company has ensured that it will be brought down. So, you have answered it, I think, in the
Yeah,
presentation
yeah.
itself.
Yeah,
Second is on the debtor days are going up from the last 4 years, and
yes.
days payable are going down. So,
Yeah.
if a company has a supply chain dominance, then
Mhm.
why this is in the opposite direction?
Yeah, so what is happening is in the last 2 years, if you look at slightly longer term, let's say 5 to 6 years, then their receivable days are pretty much, at a good levels. But these receivables have basically increased in the last 2 years only. And the explanation which the company has given is that they are trying to onboard more customers in the CDMO and the CMO segment, and that's why their domestic share has increased in the last 2 years. And since to these new customers they are giving more liberal payment terms, but even for that they have guided that in from FY26 and itself you will see that the receivable days are will go down. That's the explanation the company has given, but of course it remains a risk.
Yeah. Uh, One more question is the plant start date is confirmed by the management?
Yeah, though, so the plant, no, I haven't seen any announcement of that in BSc or NSC, but the timeline they had given was around, I think, November or December, they had given for phase one to be started. Okay. For phase two, they had done a rights issue only recently. So phase two will start around July of 2026. Phase one to start anytime. And I think that might be one of the reason why this stock is still technically it's showing strength. That might be one of the reasons.
Okay, okay. So basically, you're saying phase one is in financial year 26 itself. Phase two could be 2 years down the line, possibly.
No, no, in the July 2026. So around 8 to 10 months from now.
Mm-hmm. Okay. One last question I will take is any fire incidents in the past?
Not that
Okay.
I have come to know.
Okay.
Nothing. Nothing. Whatever I have researched, I haven't found anything. I haven't found anything in the annual report as well. Okay, I've looked at the annual report, last three, four annual reports. I haven't found anything. And fire incident happened at their peer company, Sigachi Industries, which you might have seen recently. And one of their plants was closed. And what that did was it it brought more demand to Ascent because Sigachi was not able to cater to some of its clients because of that fire incident. And the unit which is in Hyderabad is still closed in from what I know. So, Ascent is seeing more inquiries from those customers, and that's why they basically rushed the phase two. They
Mhm.
did the rights issue for that.
So they're looking for that, grabbing that opportunity from the peers, basically,
Yeah,
right?
yeah. The fire incident happened at the pier, not at the.
Mhm. Okay, great. I think thank you for your wonderful presentation. I think good start for ELT.
Yeah,
And just have a look at the chat. In
yeah,
case
yeah.
I
I
missed
will
any
answer.
questions, please answer from that.
Yeah.
Okay. Thank you for making it great presentation today.
Yeah.
Uh,
Should I stop?
yeah, you can stop it. Next presentation should be from Rashmiji. Rashmiji, you are here. Okay, she just messaged that she's connecting again. She lost the connection. So just wait for her for a minute.
Put it, Amar here.
Yeah.
Yeah. Till the time Rasmi reconnects, no, I think there was Rishi who raised his hand very at the end. Do you want to take
Mhm.
that question, yeah, for Ankit?
Yeah, we can take that. If Rishi, you are there, we can ask that.
Yeah. Is it in the chat box or where?
If Rishi
Ankit,
is online, he can ask directly. Rishi.
Yeah, hi.
You.
Thanks for considering the question. I think more or less everything is answered by Ankit Bhai, but just a quick thing. Why would not any other pharma company backward integrate? Though, of course, the cost of producing this is just 5% of the total product cost.
Yeah.
But still, why would not any pharma company try to, do it in-house and not do it by take from someone else? Because if at all the wood pulp prices are very fluctuative,
Mhm.
assuming that, if at all to control that, why would not any pharma company, do that backward integrate and have their own in-house?
See, so far nobody has done it, no. Whether they would be able to do it in the future or not, it needs to be seen. But so far nobody has done it. If that was a part of their plans, they might have already done it. I think some of the pharma companies which have the big pockets, they might have already gone into it. It's a good question, but honestly speaking, I don't have a very relatable answer to it. Only thing I can say it is somebody wanted to do it, they might have already done it.
Ankit Amar here. Can I pitch in for a minute?
Yeah.
Yeah, okay. So again, this is part of this is an assumption, but then it's a bits and pieces kind of story, right? So when we are talking about excipients, it's a very initial stage for the, it's an input to the API formulation itself. API formulation itself is a very entry stage for the whole pharma chain. तो अगर मेरा एक फार्मा कंपनी है तो फॉर दैट कोर competency is developing that formulation and getting it to the market, and excipient is one of the raw materials which you itself said is very low margin kind of business. Why is Exxon Microcell into it? Because it gets scaling comes into play where it kind of collates order and goes whole shebang to the whole pharma companies where it has a number of clients. So scaling with this would make sense, but for a pharma company whose core competency is somewhere else, this will be very minor cost kind of thing, and the focus area is not there. It gets diluted. So that might be one of the reasons.
Yeah. Very well said.
Okay, understood. Thank you so much, Amar Bhai. On the second front, I mean, on the competitive level, only Sigachi is the company that I will compare myself with, right?
No. Sikachi is one, and there is one more. Gujarat Microex. There is an unlisted company. Okay,
No,
and
in
there
the
are
listed space,
one
I'm
only.
asking on listed space.
In the listed price, Sikachi is the only one. There is a recent SME company which was called Patel Chem Specialities. They are
Okay,
also
Patel Chem.
part of
Yeah, yeah.
their revenues come from excipients, but they are not a dedicated excipients company. Okay,
Okay,
and
part of the product.
yeah, part of the product. Globally, the biggest manufacturer is DuPont. You might have heard the name.
Yeah, DuPont, MNC.
DuPont has basically cornered the whole market of North America. And
Okay.
so for Ascent, the biggest export market is Europe and South America, and even some part of Africa. In Europe, they have competition from a company called Rocketex in Germany, and there is one Taiwan-based company of which the name I don't remember. So these are the two biggest global competitors. In North America, the market is basically cornered by DuPont. So to increase get more market share in North America would be very tough.
So more or less, apart from North America, they would more or less focus on the other export markets, more or less in a way, other developing markets, you know.
Yeah, the basically like countries like Brazil, Argentina, even Europe, and even there is a lot of demand in Africa as well.
Okay, and just last question before we move to this in the second presentation. On the raw material front, what sort of fluctuations have we looked at? I mean, the wood pulp, which is one of the raw materials for this product.
Around 5 to 10% only, unless you have a COVID-like scenario. In
Hmm,
that
hmm, hmm.
case, the price fluctuations are 50, 80, 70, 80%. Unless we have that kind of a scenario, there's not many fluctuations. Okay. In India as well, there are two companies who make this wood pulp, but they use
Hmm.
it in-house only. I think PV Specialities has also backward integrated into making some wood pulp, but they use it for their own consumption only. Okay. So
Okay, got it.
Ascent has to rely on for raw material. They had to rely on countries like South Africa, Indonesia, Israel, even US, and a couple of other countries.
So more or less everything sourcing from outside India in a way.
Yeah, everything comes from outside India. Raw material, everything comes from outside. The mixing part, the hydraulic mixing and the manufacturing part is done in India.
Perfect. Okay, then. Thank you so much, Ankit bhai, and thank you so much for giving the opportunity for asking questions. Thanks. I'll join back the queue.
Okay, great. So Rashmiji is online, and Rashmiji, I have shared you the co-host permission. So just check if you can share it and start. Rashmiji, you're on mute.
Yes, Punit.
Yeah. Now it is better.
I guess my screen is visible.
Yes.
Happy morning, all. Myself, Rashmi Patil, and I'll be presenting Lumax Auto Technologies Limited. And thank you, Ankit. It was a great presentation. Uh, Before we get into automotive industry is something beyond my scope of understanding. So there was a lot of things to understand this company. So before we move into what Lumax Auto Technology is, like automotive industry, it had been in a downtrend for for a few quarters. But with the change in GST with recent, GST 2.0, there has been a huge demand for automobile industry, as well as the uh, kind of components that we are using for the automobile industry. So Lumax Auto is all about the components. Yeah. So talking about the Lumax industry, Lumax industry, it has been divided into two companies now, Lumax Industries and Lumax Auto Technology Limited. So it's almost a decade company started in 1945 by DK Jain, and it just started as a trading partnership firm. Then in 1955 to almost 2 decades, they worked on automotive lighting equipment. For a long time, they are into lighting equipment, your headlights, your back end lights, then indicators and everything. So Lumax Industries is all about lighting. And then in 75 to 85, this decade, they worked on establishing their globe automotive industries. And this is the long-time partner that is Stanley from Japan. This is the long-time partner with Lumax Industries. So Lumax Auto Electricals was something that was getting a huge demand. So they got it separated. Then in 95 to 2005, this separately it was named as Lumax Auto Technologies Limited, the company that I'm going to discuss today, and it got listed in 2007. In 2005 to this decade, they worked on they collaborated with a lot of companies because Lumax Auto Industry itself is not manufacturing anything. It is collaborating with many such companies which are doing great in the automobile industry. And these are the companies that I'll be discussing what they are into. And year upon year, their acquisition of good companies is going on. Here are the promoters. The main person is Dhanesh Kumar Jain, who is the acting chairman right now. And Anmol Jain is the managing director and is the most active person presently handling the company. And Deepak Jain is the other son of DK Jain, but is the director. And we can see Parag, then Arun Kumar Malhotra, Divya, and Gandhi as the other promoters and independent directors. As far as the company is concerned, it has many plants in different states. Recently, it has, it started in Maharashtra, then it has a good base in Gujarat now. Then it has a software related plant in Karnataka, that is Bangalore. And beyond this one, also in China and Japan, they have their base. And here, if we want to discuss how many plants, then in Haryana itself, they have 10 plants. Gujarat, they have 1. Madhya Pradesh, 1. Maharashtra, 11. And Bangalore, they have 3 plants now already. And Rajasthan, 1. And Pannagar, Uttarakhand, which recently, after forming the new state, they gave a lot of scope to the industrialization. So they came up with 3 plants there. When I say automotive components, so when we imagine a car or any vehicle, we just have an overall look like, okay, it is something with headlights, glass, then indicators, gears, and everything. But when we discuss about the components, like what all goes into making of a vehicle in general, then we have this, like you might feel like, okay, this component can be a company in altogether. So like seat structures, mechanism, your mirrors, gear shifters, plastic modules, the overall bumper, then your rear lighting system, antennas, then door visor, transmission products, your horn, your LED side indicator. So and your air intake system. A lot of things goes into making a vehicle. When we discuss of the two-wheeler, the same thing. Again, the common things are the mirror and horn and wiring that goes into this. Then the cables. Your overall this if there's a look to a two-wheeler, if it is a very trendy or a good-looking two-wheeler, then you have these plastic modules that covers the body. Then you have this oxygen sensor, which is called as telemetric. We'll discuss it later. Then your rear module integrated lighting system. This all gives a very trendy look to any kind of vehicle, but above all, it's about the safety also. And when we discuss of commercial vehicles, so here the gear shift lever assembly is there, then complete end-to-end lighting solutions, your tank, diesel tanks, then seat structures. What goes here is again metal plus plastic, and then your plastic fuel tanks. So when we discuss of this plastic, it is not the common plastic, because a lot of R&D goes into what kind of plastic we need to use. Then when we come to the farm equipments or the heavy vehicles like tractors, then also the same, your lamps, front and rear end lamps and everything, and then gear shifting mechanism here is completely different. So when we discuss of automotives, components, lot of things get into making a vehicle. So when we extract them as an individual component, then we can see here like cockpit consoles, door panels, headlights, tail lamps, then your power window switch, then telematic antenna, and gear shifting, e-shifting, then swing arms, here pre-bend tubes, CNG manifold, so your safety kit, then here mirrors, door wise, filters, wipers, horns. So these are kind of the components that goes into making of any kind of vehicle. So coming back to what exactly Lumax Auto Technologies is doing is how it is making its revenue. I mean, how it is making overall profit is. Product wise, if we talk about what exactly how much it is getting, so maximum, I mean 52% of its revenue is from the advanced plastic. When I say advanced plastic, it can be the body of the vehicle. If you see like there is more of fiber based plastic based body nowadays for any particularly two-wheeler, since the EV has been introduced. Then your mechatronics contributes to 6%, and your control systems, aftermarket. When I say aftermarket, when any vehicle is sold, you don't like it can be as simple as the footrest. So it is not a default part of the vehicle when it is delivered. So anything that you want for your vehicle after taking it from, getting it away from the showroom. So whatever you install, it can be the extra lighting you want, or the kind of stickers you want, or um, footrest, say, for the longer footrest in when it comes to four-wheelers. So everything is a aftermarket products. So this aftermarket product itself contributes to 10%. And who are the customers? I mean, when I talk about the clientele of this company, so product wise, it is making maximum profit. I mean, taking revenue through advanced plastics. Then comes alternative fuels, mechatronics, and all. Alternative fuels is like, since EV is in boom now, because government and altogether automotive industries are working towards making a better environment, working towards better environment. Alternative fuel like CNG, LNG, all things are coming into picture. So it is invested, that is almost 8% is invested in, coming through alternative fuels. And when I talk of clientele, these are like important clientele of this company is like Mahindra and Mahindra, Bajaj, and your Maruti Suzuki, that is MSIL is Maruti Suzuki, and HMSI is this Honda motorcycle and scooter industry, and LIL is your little motor car, that is your Chevrolet, you might have heard. So the biggest clientele is Mahindra, and why Mahindra and how the acquisition of other companies are making its clientele base even stronger, I will discuss in the next slide. And 20% is your Bajaj, and 13% is others. So it has the biggest clientele for its as a base. And then if we are talking about the segment wise, like how it is making revenue, uh, particularly when we discuss of the present quarterly results. So private vehicle, from private vehicle, it is private vehicle can be your car. So 55% of the revenue, the Lumax Auto is making through private vehicles. Then your 25% is two and three-wheelers. So 25% is coming from this. Aftermarket, I said like the components that you install into any vehicle. So aftermarket, this one is 10%. Your commercial vehicle is 9% and others are 2%. So as I discussed, like the biggest clientele is in case of two-wheelers, it has its Hero, then Bajaj, TVS, Royal Enfield, Mahindra, Rise, Honda, Piaggio, Suzuki, KTM, Yamaha. So these are all the best of the best companies in two-wheelers. When it comes to four-wheelers, as discussed, Maruti Suzuki, then Honda, Toyota, Hyundai, Kia, Tata Motors, Skoda, Nissan. Almost Volkswagen, almost all are its biggest clients. When it comes to commercial vehicles, also again the Tata and Mahindra, then Piaggio, then V commercial vehicles, Force, Ashok Leyland particularly, then Delmer, Volvo, SML, Isuzu. So these are the clientele when it comes to commercial vehicles. So you can observe here two-wheeler, four-wheeler, commercial vehicles, almost all the companies need the components to enhance its end product. Discussing about the order it has already received. So there's a 13, 15, 57 crores of already in-line pipeline. So 40% is in future and clean mobility. When I say future and clean mobility, it is working towards the green fuel that I said, like CNG, LNG, and alternative fuel. Then 20% is for mechatronics. When I say mechatronics, here it is only contributing to 6% of the revenue. But the order they have is, I mean, 362 crores is already in name of mechatronics. And advanced plastic is something that has always been more than 50% of revenue is always through advanced plastics. And 679 crores is already assigned to that. And when I talk of this 1357 crore order book, it is distributed in 4 years. So from 26 to 29, this is what they have. 26, they are spending around 94 crores, that is around 77%. And rest of the 80%, they are spending in FY 27 and 28. And the last 10% will be spent in FY 29. And this is how they are going to, I mean, the percentage of orders they have in different way of spending. The company MD Ankit Jain, he said like he's very confident and his guideline increased from 20 to 25% EBITDA this year. He said like very much sure that we are going to maintain the CAGR of 20%, ROE CE of 20%, 20% EBITDA margin every year, and 20% through future and clean mobility. So when a company MD assures you, so how does he, I mean, assure that this will be achieved? So here is the minimum 20% revenue CAGR, that is from past to future target. Present, I mean, from FY 2025, their CAGR has been 1100 to 1900 crores. So it has all been organic growth. But now, by acquiring different companies, excuse me, by acquiring different companies, inorganically also, it is going to achieve the rest of the 20%. So 8,500 by FY 31 in next 6 years. From presently it is FY 25 is 3,637 crores of CAGR. When we talk of next 5 to 6 years, they are very much positive on achieving this 8,500, and rest of this 20%, that is overall 11,000, rest of this 20% will be inorganically. So new product segment is in clean and future mobility. As I discussed that they are into working on alternative fuel. Then they're also working not just the components or hardware part, but working on the software-driven solutions, and mainly by premiumization. So if you presently understand, initially around, if we talk around 2 decades back, owning a car was a status. Like a person is doing well, a family person is doing well, the head of the family would bring a car. But now, irrespective of how many family members are there, every individual wants to own a car. And when it's just not owning a car, but high-end model. When you bring in a vehicle, then we have the basic model that starts. But when you go for a high-end vehicle, then you invest a lot in the vehicle that you buy, be it two-wheeler or the four-wheeler. So this is how they are going to achieve this CAGR of 20%. And when they talk of 20% EBITDA every year to year, from FY22 to 25, this is what has been the growth. And they have been almost consistent with 13 to 14% of EBITDA. But now they have the vision. They don't give a timeline to this. They have a vision of maintaining 20% every year with ROCE and EBITDA of 20%. And 20% from clean mobility is like right now their investment is only 6%. Now they increase it to 14, and by FY31 they want to get into 20%. Okay, like as I told, they're achieving a lot through acquiring the companies, and here are the few partnership they got into. And IAC is one company, that is International Automotive Components. So this is one company where from May 25, 100% acquisition is there. What IAC is into, it is usually into the digital content, that electric devices and components. So how many plants? It has taken over one plant. And who are the key components of this? This Maruti Suzuki and Honda motorcycle. But apart from this, Mahindra and Mahindra was already, I'm sorry, sorry. Sorry. Um, so IAC is into vehicle interior systems and components. And how many plants it has? It has already 7 plants, and all the 7 plants have been acquired by Lumax Auto now. And what is the order book for the already IAC? It has is 580 crores. And who is the biggest clientele of IAC? That is Mahindra and Mahindra. Mahindra before, is in collaboration with Lumax Auto, but was completely in sync with this company IIC. So since Mahindra and Mahindra, or otherwise is also biggest clientele of Lumax Auto, but is also in collaboration with this IIC. So acquiring this IIC confirms the strong bonding of Mahindra and Lumax Auto. So the order book is 580 crores, and key financials for this is already it has generated revenue of 694 crores, EBIT of 123 crores, and profit after tax of 56 crores. And there's one more company called Mano, and this the 55% acquisition is there. And what is this company is gear shifting, lever system, lubricants, fluids, force cutting products, spare wheel carriers. So how many plants? 3 plants. And as discussed, all the big, commercial vehicle, this one are into this Mano company. And what is the order book they have received for this is 80 crores. And right now already executed is 189, achieved 29 crores of EBITDA and 18 crores of PAT. Cornaglia is other company where it is into plastic tanks, then ducts, sheet metals, air filters, urea tank, all this. So number of plants acquired of this is 2 plants. And who are the clientele of this company? The Tata Motors, Toyota, Volkswagen, Mahindra and Mahindra. And already the order book is 55 crores. And this is what has been achieved. There is Alpine. This is into electronic devices, industrial equipments, and components. Number of plants they have acquired is 1. Again, the Maruti Suzuki and the Honda motorcycle are the clientele of this. Order book achieved is 30 crores. Revenue already they have got is 53 crores with EBITDA 8.2 and PAT 4.3. And Ituran is another, which is into telematics. What is telematics is like the combination of telecommunication and informatics. They collect, monitor, and transmit the data. This is all about the telematics. And the plant they got is 1, and who is the clientele is Daimler India, and order book is already 10 crore achieved, and this is the revenue they got and PAT they got. And one more is Yokowo. I think this is the company you might be seeing here and there everywhere. So the number of plants they have acquired is 1. And what is Yokowo into? It is like electronic components, antenna, wireless communication, and mainly into the communication part. And 70 crores is already achieved. Revenue is this, but here they have got a little loss of minus 1.4. And ZOP is into gear knobs, mechatronic assemblies, power metallurgy, then precision machinery, e-shifters, smart accurators. So you can just observe what kind of, I mean, when we talk of acquisition of the companies or in getting into the joint venture with the companies, so there's a lot of different things that each company is into. It's not just about the telematics, it's not just about the plastic, it's not just about the lighting system. So each company is working differently, and Lumax Auto itself is not producing any kind of or manufacturing any kind of component. Rather, they are getting into the collaboration of the best companies, where they are working on different kind of enhancing of any vehicle. And when we talk of FAE, it is into sensors and switches mainly, particularly the oxygen sensors. And the green fuel, I think this is one they are going to acquire more. Already they have acquired 60%. They want to work on this part more and more, because this is the one that will get Lumax Auto more revenue in coming future. That when I say green fuel, then it is like CNG, LNG, hydrogen. They are also into lithium ion batteries. So when you see, each company is working on different aspect of vehicle, and the number of plants also they got into is 100% of this company, 55%, 50%, some 84%. So you can understand that Lumax is here to stay with different kind of working on different kind of components, mechanics, telematics, sensors, software, in every sense. Now, talking of 20 years, I mean 2 decades of Lumax Auto Technologies, how the journey has been so far. When it comes to revenue, when we talk of 2005, it was hardly like 100 crores of revenue. Today, they are generating the revenue of 3 crore, I mean 3,637 crore. When we talk of product lines, they were mainly only and only into lighting system. That is your headlights, rear lights, and indicators. But now, today, they have diverse 13 plus advanced plastics, interior solutions, metallics, lighting, aftermarket, sensors, electronics, telemetrics, alternative fuels, by acquiring different companies. In when we talk of manufacturing plant, they had only one plant in 2005, but today, either through acquisition or expanding their capex, they have 30 plus facilities pan India. And when we talk of engineering strength, before they were into reverse engineering. When I talk of reverse engineering, what does reverse engineering is? Like, say, you are Lumax Auto and I am the client. I want, I mean, one of the automobile companies, say Mahindra and Mahindra. I want a kind of like I'm building a SUV and I want certain technology to be implemented in my vehicle. What Lumax would do is, first it would study the same kind of, I mean, bring in that component from other company, study it, turn it into the kind of, I mean, customize it for my taste, and then sell it to me. But today they have more than 650 innovation and IPR focused. That means they're more into R&D now, more of getting into patents and everything. They have such technology that the company is not defining or customizing anything. They have so much diversified products that I, as a company, I'm ready to pay what you're asking for. So this is the change in these 2 decades. When we get into strategic JVs and alliances, that is joint ventures, 2 decades back they had no JV or anything, but today 9 global joint ventures and alliances are there, which is bringing in more. They're getting into a lot of diversification, premiumization, as well as a lot of revenue from different aspects of the components. Then, when we talk of sector focus, they were only and only into two-wheelers. And when I talk of two-wheelers till date, India is more into two-wheelers than the cars, I mean four-wheelers. So today they have the healthy mix of private vehicles, two-wheelers, and commercial vehicles. So you can see just in 2 decades, what has been the kind of change Lumax had been through. And since EV is in boom, government is also promoting a lot of EV. They are trying to be in more environment friendly now. So when we talk of this revenue, I mean, what kind of product lines they are offering, like cockpit consoles, headlines, door panels, air intake system, tanks, antennas, gear shifters, and all. Um, Initially, there was around 5 to 10,000 of any, I mean, say Lumax has any component. As a company, I would order for one vehicle around 5 to 10,000. But today, this is just in 5 years, last 5 years, there has been 5x growth. That means at least there is 70 to 75,000 of products taken for one vehicle from a company. And this is in to a four-wheeler. When it comes to two-wheelers, you have that lamps, fenders, sensors, frames, swing arms. So initially it was around only 5,000 product, but again it has also grown 5x. Now today at least 25,000 of products are installed from Lumax. So when we talk of this last quarterly result, Lumax has outperformed all other peers compared to the previous revenue. It has the highest revenue this year, that is 1,156 crores, and this there has been 36% up in the revenue. And when when we talk of aftermarket products, that I said, like once the vehicle is out of the showroom, there is at least 20% of the growth only by aftermarket products. And as I discussed, after acquisition of certain companies, this has been there's a complete 36% year-on-year revenue after acquisition of these two companies. I mean, IAC acquisition has just made a strong base for M&M, that is Mahindra and Mahindra. And green fuel, they're working, I said, like already they have generated 95 crore and they are working more towards it. And when I talk of EBITDA, 13% up is there, but the company, I mean, Ankit Jain is so confident that he is ensuring that upcoming 3 to 4 quarters, he'll be generating 20% of EBITDA. And they already have free cash of 359 crore. Debt is almost, nil now because they have enough money and they're not going for any more debts. Capex, they have already present whatever they had, they have already invested 31 crores in Gujarat land, and full year guidance Capex is 200 crore. Either it will be acquisition of the companies or expanding their land and uh, getting into different states of the country. So IAC is a complete 100% subsidiary since May 2025, and Lumax Mano, this company acquisition, they got as the best manufacturing SME of the year, and Ituran acquisition, they gave the best partner of the year. So they are acquiring or getting into JV with those who are already doing good, who are already generating good revenue, who are already working better, doing better in the R&D. Talking of the fundamentals, you can see here from March 2014 till March 2025, the kind of sales they are into. So year on year, their sales have been increased. And since I said like they are more into premiumization, very likely the sales will keep on increasing. And when we talk of operating profit, it is 554 crores. And when we talk in terms of percentage, it is 13%. And when we talk of promoters, from past 3 years, if you see, there is no change in promoter holding. That is almost 56% is the promoter holding since 2022. And if you see FIS, though it was 19%, now it is, though it got reduced to 5%, and now again they increased. The FII have increased to 7%. But the same percentage has been, taken up by DIIs from 5% to today 16.5% is the DII holding, and public holding it's between 19 to 20% since 3 years. But if you see the number of shareholders, they have been increasing day by day. And when we talk of compound sales growth, 10 years, from a decade, it is 11%. And talking of the present, also, it is 11%. And profit growth is 16% for last decade, whereas present it is gone down. But overall, general talking, 3 years, it has given 8%, 5 years, 3%. And CAGR, as I said, like 10 years, it has given 36%. But only this year, 200% of CAGR it has generated. And return on equity, that is ROE, it is 13%, almost maintaining this 10 to 13% since a decade. Okay, like why Lumax is going to grow? Because I said like it is not just two-wheelers, it is already into commercial vehicles, your private vehicles and everything. But why Lumax is going to stay here? India's automotive industry, if we talk of in general automobile industry, it has contributed to 7.1% to GDP and 49% to manufacturing GDP. India is the fourth largest automobile producer globally, and when it comes to auto component, the market remains only 3%. So you can see this huge possibility of growth since hence we are the fourth largest automobile producer, but almost every person wants to own a vehicle today, particularly a car. And when we talk of premiumization, we are not going to take any basic model. We are going to invest in the higher end model. Then this percentage is gradually going to grow. With the right enabling conditions, India can triple the export of up to 60 billion and can generate 25 billion trade surplus. So by 2030, we have a target of 2.5 million direct jobs through automobile industry. And 2023 to 24, India produced 28 million vehicles. And in this, if you observe, 21 million is two-wheeler. You can see how much dependency, considering the population, the kind of roads we have, and the affordability. So 21 million is two-wheeler sector, and 6 millions are car, which is very likely to grow with upcoming 2-tier and 3-tier cities now, and the commercial vehicles are obviously going to grow. So globally, what is shaping this, automobile industry? The rise in the electric vehicles, that is EVs, have been promoted since long by the government from past 2 to 3 years. China, sorry. China has always been our competitor, but we can nowhere be near to it. So it is producing 8 million EVs in 2023 alone. So it has produced 8 million EVs, and we are into EVs. We have started it from 2 to 3 years now. There is a lot of growth getting into EVs. And when we talk of digital and advanced manufacturing, see, like today, when we talk of EV, it is not just about battery or the mileage or anything. We are more into AI now. So how we can improve that screen? What more we can get into it? Can we provide the map into the screen? Can we provide the real-time data? So when we talk of automobile industry, we also talk of AI, robotics, digital twins, the Internet of Things, and 3D printing. So the scope is wider, and sustainability and circular economy, automakers are moving towards carbon neutrality. Since I said like EV is promoted, as well as like CNG, LNG when it comes to the four-wheelers, we are more fuel efficient, and it can be as simple as ethanol blending also, though whether it's a success or not, that's a different story. And few companies are already getting into that. That is, BMW is into EV battery cycling, and whereas Volkswagen is into renewable energy sourcing. And sector-wise, auto industry is a major consumer of steel, electronics, rubber, glass, textile, and IT industries. So when we talk of automobile industry, we are also talking of steel, we are also talking of electronics, we are also talking of rubber, we are talking of AI, we are talking of robotics. So there is interdependency. If this sector is going to grow, quite natural, the other sector is also directly in sync with this companies, this sector growth. So but talking of a little, the pros and cons here, since it is dependent on steel, electronics, and other things, the raw material acquisition of plastic, rubber, steel, this is directly going to affect this company. Like when I particularly talk of Lumax or the companies that are working into components of the vehicles, so they are directly going to affect. But apart from that, the demand is so much that they are likely going to stay here. And how the present government is supporting is the FAME, that is the faster adoption and manufacturing of hybrid and electric vehicles. So this scheme has been pivotal since 3 years, and phase 2 is already like the outlay is 11,500 crores, focusing on EVs, two-wheeler and three-wheeler buses. So if you see that already, two-wheeler is more and more companies are coming into picture, and the cars and buses are also getting into EV now. And PM E-Drive scheme is introduced since 2024 to 26. These 3 years, they are going to accelerate the EV adoption and the charging points. And the budget allocated is already 10,900 crore for the same. And they are going to target a large scale of EV vehicles. So particularly 25 lakh of two-wheelers, 3.2 lakh of three-wheelers, and 14,028 electric buses. So if you see, particularly in Bangalore, at least I'm seeing a lot of EV buses now, and 2,000 crore is earmarked for national level charging it, because we have EV, but we face problems in charging points. So 2,000 crore is earmarked for the charging infrastructure expansion. When we talk of production link incentive, that is PLI scheme, so 44,038 crore uh, is for battery, storage, and the flagship initiative aims to boost the domestic manufacturing of advanced automotive technology. So the government is also focusing that we are very less dependent on outsourcing anything from outside, and more that Atmanirbhar and Make in India products have been encouraged. So when I talk of Lumax, it has been listed in 2007, and you can see up to almost 2020. So this has been a very stagnant kind of growth, because initially owning a vehicle was not a status quo but was a essential thing, that is a necessity. But now owning a vehicle is not only a status quo but enhancing it with lot of components, more of technology is a flashy, a craze for the present generation. So from 2022, from past 3 years, you can see the kind of growth Lumax has achieved. And when I take day basis, when I talk of this technical analysis, you can see every single day it is hitting, new ATH, that is all-time high. And I'm trying to see the possibility of taking this stock, but I see that every single day there's a new high made presently, particularly after the last quarter, quarterly result. So concluding, when I talk of the returns Lumax Auto Technology has made from 10 years, only from the past 10 years, if you are holding this stock, it has already given 1,977%. If you talk of only 5 years returns, again 1,400%. Then 3 years, almost 460%. And only the 1 year last year return is 195%. And talking in terms of the target price, when we talk of different analysts analyzing this stock, then there's a possibility of getting low to 767%, just because possibility of covering this gap. And uh, presently, the price is 1536 per share, and it can go as high as 1860. Quite possibility, because the ensured EBITDA, revenue, the company, whatever it has ensured, it has already achieved, it is achieving. And this is what has safety pin to do with Lumax? Nothing. I just want to say that people invest this amount in a kind of safety pin. They invest around 1,35,000 in only owning this auto rickshaw kind of bag. They want to invest, spend 80,000 on ink waste shirt. So you can understand like the kind of craze people has now. So when you imagine a vehicle, owning a vehicle, so it comes to flexing of what kind of vehicle you own, what company you own, again, what components, how much higher end vehicle you are going to take, the craze, the flex, the status quo you maintain. And talking of the other part also, when we talk of owning a fancy number, I'm talking about how the automobile industry is. Owning this fancy number, you are going to pay equal to the amount of the vehicle you have paid. So like owning this number, you're going to pay minimum 10 lakh it starts, the RTO itself charges. So these are the different kind of rates that you pay for the number itself. Even if the vehicle is put to scrap, only by selling this fancy number to different owner, you are going to make this amount. So I just wanted to highlight on kind of premiumization, the flexing, how much a person is ready to spend. So Lumax in general, when I talk, the promoters are strong. The company has been generating the good revenue from last 2 to 3 quarters. It has generated what it has assured already, and more manufacturing units. They're getting more into software, not just the hardware. The client base is quite strong. The JV or the acquisitions are such companies where they already are doing very well, and the fundamentals are also strong for this company. Year on year sales is growing, EBITDA is growing. So overall, I'm quite positive. It is hitting 80H every single day presently, and quite the possibility that the next 3 to 4 before the 4 quarters, it will make 2x. So the possibility of the stock getting 3,000 odd is a possibility. So here I end my this one, and I'm open to queries.
Thanks, Rashmi. So first question is from Somnath. Yeah, Somnath, you can go ahead.
Yeah, thank you for the wonderful presentation, Rashmi.
Thank you, Somnath.
Am I
Yeah.
audible?
Yes,
Yes.
yes.
Yeah, so I have been holding Lumax Auto for a few
Great.
months now,
Yeah.
and
Okay.
one correction in the kit value of per car is it is
Mhm.
50,000. It is not 75,000. Company is aspiring it to become 75,000.
Okay.
That is
The
one.
data was picked up from the company's presentation itself. So I'm
Okay.
sorry if it is wrong. Yeah.
Yeah, in interview they have given the
Yes,
number.
yes.
So
Mhm.
50 to 55,000 is the current kit value per car, and they are
Okay.
aspiring it to be 75,000 in
75.
future.
Okay. Okay.
And second thing is the current valuation versus the growth. So current valuation P is around 50, and the growth is, if you say 20% or 25% growth.
Yeah.
Where do you
The valuation is quite high.
Yeah.
I
So
know that.
yeah, so that is the reason I'm unable to top up, in fact. So
No, like when I come to valuation, yes, the valuation is certainly high, but will this affect, I mean, considering the present PA and all, but with the present valuation also, the company is still going to give you the returns expected. This is for sure. This is, I put in a little more efforts in understanding that, but right now, if you're holding, there will be no disappointment for sure.
yeah, the peg is 2.5 times. So that's the risk I feel in this stock.
I think it is 1 point something, Peg. I'll just check it
So
because it is not
P is
cross P.
50. If the growth is 20, then the peg comes to 2.5, right?
I just checked it. It was not 2.5. I'll just check it again.
Sure.
Yeah.
The valuation is the only thing I have.
Yes, yes.
Problem.
Valuation is quite high right now. Yes. But with the present valuation, since the company has delivered already what it had promised, and it is, I mean, it outperformed the other peers compared to.
Yeah, it is best in the peer. That I
Yeah,
agree.
yes.
Yeah, thank you. That's fine.
Thank you. Any other?
Sorry. Other discussion is more on the similar lines on the huge opportunity and other things. I just want to update that there are so many other players which are watching for the same huge
Yes, when I
opportunity.
talk of its competitors or when I talk of the revenue that other companies are making, like if you're with Puneet, you already know the kind of companies that he has already suggested and they're doing good. So the companies like Bharat Forge, Recall, Ask Automotive, Bosch, PM, Bellrise, Excite, Motherson. So these are the competitors. They're also doing good in this industry. Naturally, the competition is high, but Lumax has outperformed all these. And why Lumax is going to do much better than this is because of the diversification. So diversification and premiumization is going to give it the kind of expected results.
Yeah. Yeah, only valuation, I think people should take care of that part if they're convinced. Otherwise, I think it's a good opportunity in any deal. That way.
Yeah.
Okay, thanks, Rashmaji, for your wonderful
Thank
presentation
you.
and the poise you bring with that.
Thank you.
So,
Thank you so much, Puneet. Thanks for giving this opportunity.
yeah, we'll move to the next presenter, Shekharji. Hi, Shekharji. You are on call, right? I've given you the co-host.
Yeah.
Okay. Yeah, go ahead, sir.
Okay, let me share my screen. Can you see my screen?
Yes.
Okay. Perfect. Hello, everyone. I think two good names already discussed. I guess by end of these 2 days, we probably will end up with some FOMO and less cash. So let's see how Monday goes through. So I'm talking about a company that's in the healthcare space. Essentially, it's a hospital. I think many of you might have heard this phrase from Mr. Aditya Kemka, that hospitals is the only business where seller will tell the buyer, what to buy, when to buy, what price to buy, and for how long to buy, and more importantly, when to come back. I mean, it's not a fun business. Obviously, I'm pretty sure most of you would have had those experiences of being in a hospital and then how painful some of those doors can be. But at the end of the day, it's a need for the human beings, and hence some of these hospitals are doing a good job, even though sometimes we feel like they are, cheating us with too much of expenses. But business is a business. So before we jump into the actual hospital that I have in my mind to discuss, I just wanted to take you through few charts. And I'm pretty sure if you have invested in the hospitals already, or if you have attended any of the hospital seminars before, you would have come across similar data points. So I'm not really trying to tell you any brand new here, but I thought I'll just refresh your mind before we talk about the actual hospital. SYEC did a very famous webinar about 2 years ago when it kind of opened up the eyes of many people in terms of how to measure hospitals, and then Sajal Kapoor spoke about this sector quite a bit, and then of course Aditya Khemka is well known in uncovering this. But long story short, no matter who gives what sort of a message, end of the day, it all comes down to how much of a need we have and then how much of a shortage we have. So there is a demand supply challenge, both in terms of the beds, in terms of the hospitals, and even in terms of the professionals, right? And at the same time, some positive things that have happened in India in the last 6, 7 years is that the health insurance awareness has gone up. I mean, you see lot many ads. You see Ayushman Bharat from central government, and then you see a lot of health insurance schemes even from some of the states as well. Although they have a cap of 5 lakhs, 7 lakhs, etc., but something is better than nothing, right? At any given time. Uh, Plus the fact that many of the GCCs are coming up and many of the offshore setups are happening, manufacturing companies are increasing. So there is a lot of private employment that also caught up in India over the last 10 years or so. And more or less, most of these private players, they offer a pretty decent healthcare coverage, right? And they also give you opportunity to top up. So multiple reasons, but long story short, health insurance is catching up quite faster, which obviously makes people, affordable to reach out for good healthcare. And then one important point that I'm pretty sure all of us would have heard about is, once your per capita crosses certain stage, whether it is $3,000 or $4,000 or $5,000, I leave that number to that threshold to the experts. But the bottom line, once it crosses certain threshold, the incremental money that we make, obviously we will spend that on consumption and we spend that on taking care of ourselves, our healthcare. Right? Which is one of the reasons, obviously, why we had seen so much of a boom in premiumization in the last few years. And we will continue to see. I think that's one of the points that Rashmi was alluding to earlier. But between the consumption and healthcare, the truth to be told is obviously healthcare is more important for us, right? I mean, if I have everything else taken care, my health is exceptional, yeah, I'll go spend whatever the money I want to spend on a travel or a hotel. But if my health is not doing so great, or somebody in my family is not doing so great, my consumption goes into completely backseat. I'm going to spend all my money on the healthcare, right? So that's obviously another trigger that as the per capita goes up, we will end up spending a lot more money on taking care of us. Healthcare doesn't necessarily mean going into the hospital, by the way. It could be, preventive healthcare as well. And then, of course, the number of beds are extremely low in India. For every 1,000 people you take, we have somewhere between 0.5 to 1.5. You look at some of the other countries, it is significantly higher. So there is a lot of catch up to do. And hence, sometimes we hear this thing that, oh, there are too many hospitals in this city, there are too many hospitals in South Delhi, there are too many hospitals in Gurgaon, so on and so forth. They are not enough, to be honest. We need more. Obviously, at a more affordable pricing, that will be nice, but we still need more. And then the other part, which is the nature itself, what we have seen in South Korea, Japan, and what China is experiencing right now, And some of the countries in Europe, you look at Italy and some of the other countries, the aging population is catching up quite very fast, right? There is a meme or a joke, I don't know how truth it is, that in Japan they have more old age homes than the schools, right? Maybe it's true. So that is the situation. Fortunately, India is not in that bucket yet. I think we have excellent demographics right now in terms of age, which is why many of the folks are calling that this is India's decade, that the next 10, 15 years should be good for India. But the truth is, down the line 15 years, India will start getting into the same situation, whatever China is right now, right? And hence the need for hospitals will continue to go up. That's the unfortunate truth. Last but not the least, the medical value tourism. And again, we have heard this phrase quite a bit in the last, 5, 7 years. It kind of took a dip during the COVID for all the known reasons, but post the COVID, again, it picked up even at a faster pace. You look at any major procedure, the affordability, the price in Indian good hospitals is anywhere between 70 to 90% cheaper than what someone has to pay in their home country, right? So there is quite a bit of folks traveling from Africa, Bangladesh, Afghanistan, Maldives, Mauritius, and whatnot. And at some stage, obviously, even from the some of these developed nations also, people will start traveling. I mean, that's a fact. So this is continuing to go up. And one important aspect here I would like you guys to remember is that there's a non-profit organization called Joint Commission International, JCI. So typically, unless you have accreditation from them, people may be hesitant to come to you as a medical tourist, right? The reason I mentioned this is if you are tracking any hospitals, it's good to check if your hospital has this accreditation. So, long story short, there is fewer number of beds than what we need. Our per capita is going up, which is an excellent thing, not only for healthcare, but for a lot of other sectors. Insurance penetration is catching up and catching up well. And then, of course, the medical value tourism is kind of, picking up and consistently growing. And that brings us to why we should look at hospitals. While the discussion that I'm going to do in the next 25, 30 minutes is going to be on Artemis, but the truth is there are multiple hospitals that are doing well. Of course, I'm pretty sure some of you are already invested in those, some of them. And hence, in case if any one of you are not invested in hospitals as of now in your portfolio, I mean, you don't have to look at Artemis only. I mean, you can look at the whole broader set. We'll talk about some peers towards the end of this slide. But hospitals or healthcare broadly is an excellent sector to have some presence in the portfolio. Whether it is hospital side, whether it is the CDMO side, whether it is the API side. I think Ankit was talking about Accent Microcell in the first session. But definitely a good portfolio to have, I mean, good allocation to have in your portfolio. So let's understand what Artemis does. So before we begin, just a standard disclaimer. I'm not a SEBI registered RA and I'm not officially or qualified to give any buy or sell recommendation, and hence this is just an information for your benefit. If you like in the next 20 minutes, if you like what you see, my humble request is please do more research, because what happens. Can you guys still hear me?
Yes, go ahead.
Okay. So my humble request, whether it is me or the previous speakers, Rashmi or Ankit, most of the times the presenters are always biased with their companies, right? That's a fact. But as an investor, we need to take unbiased decision. So no matter whatever you read through in the next 20 minutes, please do double check. Please compare before you take a decision. So let's understand the bigger picture. So Artemis is one of a super specialty hospital. It's
So
based on.
Shekhar, just 1 minute. You're going to the next slide. We are just seeing the first one till now.
You are still on the first slide?
Yep.
How is that happening? Let me share one more time. I'm actually going to share my screen, so that might be easier. Hopefully, let's see. Can you see my screen?
Yes. Now it is on the setup. Yeah.
Okay. Can you see the preview? So you guys didn't see other screens, is it? This screen, did you see?
This we could not see. We thought we were just speaking.
Oh, I'm so sorry.
Yeah, no
Didn't
problem.
realize. Okay, you can see the slide up board now, right?
Yep, yep.
Okay, so when I was talking about the number of beds and the demand supply, the number of professionals on the lower side compared to the demand we have, or the insurance penetration, how the healthcare spend is going to be a notch higher than the consumption spend once your per capita across a certain numbers. These are all the different charts. Let me move to the next slide. You can see the next slide as well, right?
Yes, we are
Okay.
now it is changing.
Okay, perfect. So this was another chart that I was referring to where the number of beds in India are comparatively lower compared to many other countries. For every 1,000 people, we have just about 0.5 to 1.5 sort of a beds, which is extremely low. So obviously there is a significant need for us to keep pushing that up. And then this was the chart that I was referring to, aging population. So like I was saying earlier, India doesn't have a serious challenge right now, but down the line, 10, 15 years, we will start, growing in our aged population as well. And hence the need for hospitals will continue to enhance and expand. That's a fact of life. And then this was the chart I was talking about, how the medical value or the medical tourism is kind of catching up because the affordability is so handsome in India. Many of the medical procedures you pick up, we are 70 to 90% cheaper compared to many of the other developed nations. In fact, in my view, based on my personal experience, the only other country that comes close to us is Thailand. I think Philippines also has a good thing. I couldn't get those numbers, but Thailand, Philippines probably have some good medical facilities, but they don't have that sort of a scale beyond a point. I mean, the kind of growth opportunities we will have in India will significantly outperform. So that's the long story short. Fewer number of beds, good per capita increasing. Insurance is catching up quite well, thanks to the government as well as the private employment. And then, of course, there's a lot of customers coming from other countries into India. So that's why I personally believe hospitals is a good place to have a position in our portfolio somewhere. I mean, not obviously too much, but certain allocation. So let's talk about the overall setup of Artemis. Hopefully you can still see the screen. So right now they have one large super specialty hospital in Gurgaon. It's a 700 bed capacity. But the rest of the facilities are coming up. So we will go through each one, quickly, so you get a bigger picture. Understanding this entire picture is probably going to tell us the entire story about is this a good investment opportunity or not, and hence, if you have any questions, please note them down, and then we can discuss in the Q&A. So right now they have a 700 bed facility. It is in, as of last quarter, it was 64% occupied. Matter of fact, the occupancy was higher a couple of quarters ago, but it has come down to 64 because the number of beds have gone up, right? I mean, simple math. As the occupancy increases, they add more beds, and hence the occupancy comes down. Then the occupancy will catch up again, and then they will add more beds. That's the cycle of hospitals anywhere and everywhere we see. So same thing, no difference here. And in addition to that 700, they also have plans to add 300 more. So how these 300 more will come up is in twofold. One, this facility, they have received platinum green building, some certification. I'm probably not stating the complete name, but something to do with the green energy. And it has a platinum certification. So that allows them to add 100 more beds without any additional approvals. And then on the top of it, what government had opened up recently is that you can buy some additional floor area ratio. Basically there is a ratio. If you have 10,000 square feet, how many beds can you put? That sort of a calculation is there. Now government had opened up for hospitals to procure a little more. So based on the size of this particular facility that they have in Gurgaon, these guys can procure 200 more beds. So that gives them additional 300 bed opportunity. And they are not in a rush. Obviously, like I was saying before, the utilization catches up, then they'll add more. So the plan that Artemis has is when this 64% occupancy goes up to 70%, then they'll start adding more beds. And that will be a continuous cycle. So they won't add all the 300 at one go. They'll probably add 50 or 70, whatever. And then again, it catches up another 100, so on and so forth. And hence these 300 beds are going to come up over the next 1.5 years. That's my interpretation. And then they have the ARPOB at close to 82,000. It is the industry leading, one of the highest in the country. And they still expect it to grow 6 to 8% year on year. So one point that I would like to call out is when we say ARPOB growing, by the way, it is the average revenue per occupied bed, ARPOB stands for. So when we say it is growing, it doesn't necessarily mean it is going because of the prices going up, right? So most of the times ARPOB goes up because of the patient mix. For example, I'm doing more cardiac surgeries or I'm doing more oncology treatments, then obviously those patients will fetch or rather spend more money compared to a regular surgery, right? So that sort of a patient mix, and probably having more medical tourists coming to you because they'll obviously spend more money. So there are a variety of reasons why ARPOB can go up, not just for the price. And the good thing, because this facility is already existing and they're gonna adjust within that facility, their future capex for those additional 300 beds won't be monumental. I mean, it will be about 70-75 lakh per bed. Whereas if they were to set up 300 bed brand new hospital, that would have been much, much higher than a 70-75 lakh per bed, right? So that's about Gurgaon, where they have a solid ARPOB, industry leading, matter of fact. Super specialty continue to go up, and they are hoping to hit 70% occupancy in the next couple of quarters, at which point in time they'll start onboarding additional 300 beds over the following 1.5 years. And then there is the next facility, another super specialty hospital at Raipur, Chhattisgarh, where the construction is already completed. As we speak, the interior setup is happening and it is expected to be operational by end of March next year. So which means in FY27, the 300 bed facility in Raipur will add to the top line, but it may not add to the bottom line because any greenfield facility typically takes about a year to year and a half for break even, right? It takes some effort. And hence in 2020, in FY27, the top line should be reasonably show good growth, but the margins may not really expand. In fact, margins could see some sort of a pressure. Then you could ask me, hey Shekhar, then why are you even talking about it? I'll touch upon that part a few slides later, how it may not have too much of an effect. But the plan there is to grow it, get break even in about 1.5 year. And then from there on, the operating leverage will play out. And the average revenue per occupied bed is going to start somewhere in the mid 30s and reach up to mid 40s, probably a year and a half to down the line. And that's how the tier 2 cities are. I mean, in a tier 2 cities, you can't expect 70-80,000 sort of ARPO. It's never going to happen. In fact, many of the hospitals, even in the tier 1, they are struggling to maintain that 40 to 50K, forget about 70 to 80K, because of the continuous expansion. It's the same thing with Artemis as well. And then the capex that they have spent is about 110 crores. Some of it's still being spent because now they have to set up the interior part and the setting up all the beds and the medical infrastructure and all of that. But overall, the capex is about 110 crore. You might be wondering, doesn't it sound a bit low? It is because the way they have set up the Raipur facility is through partnership. There are two well-known doctors in Raipur. So what Artemis had done, instead of trying to venture out entirely on their own, they've partnered with those two well-known guys because one, it gives them the local branding quickly. Because most of those tier 2, tier 3 places, you go to a hospital because of a doctor, right? Whereas in tier 1, you probably choose a top hospital. Especially in the smaller scale, you look for a good doctor, and whichever the hospital the doctor is, that's where you will go. So that's the approach that Artemis has taken. They have onboarded a couple of good doctors, and through them, they'll onboard a lot of other good doctors. So they'll be able to attract some really good names in Raipur. That's their plan. And hence the development and the land rate, etc., was much cheaper. So basically, land is owned by those two doctors, and they are getting some profit share. So that brought down the capex on Artemis's front, which is a win-win strategy. But what the management had told about is that in FY27, most likely this Raipur facility may incur about 18 crores EBITDA loss. Like I was saying earlier, any greenfield hospital, your first 1.5 year, you're not going to show profits. So same thing with Artemis, about 18 crores EBITDA loss. I'll talk about how they are trying to compensate for it in a few minutes. And then the third one, which is going to be a landmark sort of a facility, a 650 bed that they're planning for in South Delhi. The construction is expected to start in March or February sometime next year, early next year. What management had called out is that they're going to make some formal announcements about it in the month of December, right? So which is just around the corner. So we should see some announcement about South Delhi in the next few weeks in terms of how they're gonna fund this. And what sort of partnerships they may have, and so on and so forth. I'm presuming that something what happened in Raipur, a similar setup may happen, not necessarily for land, could be other thing, but some sort of a partnership to bring down the expense, overall capex. Otherwise, typically, if you have to set up a 650 bed sort of a hospital, that to a super specialty hospital, your capex could be anywhere between 750 to 850 crores, right? That's the kind of money we are talking about. So we will see what kind of plans come out in the next couple of weeks. And then in addition to the Gurgaon facility that they're already running today, what Artemis had done over the last 2-3 years is they've started some clinical sort of a setup, right? For example, they have Artemis Light, which is a walk-in sort of a place. Then they have Daffodils, which is for women and kids. Then they have cardiac care, which is a JV with Philips. So overall, about 10 centers are there. They kind of operate in hub and spoke model. So while many of the patients who will be walking into any of these centers don't really need a hospitalization, but wherever the doctors there see some serious care is required, then those are the referrals that go to Gurgaon. So in that sense, some of these facilities are helping the patient onboarding from these centers into Gurgaon Hospital. So that's how it's happening today. But in fact, all of these were kind of running in losses pretty much. The latest update is that the cardiac care, which has 5 centers, it has apparently turned EBITDA positive. So hopefully no more losses there. That should help the EBITDA to go up in FY27. And then likewise, Light and Daffodils also will turn EBITDA positive by February, sometime in Q4. So long story short, what is expected is the EBITDA bleeding that was happening on these 10 centers will stop, and that should potentially offset some of that 18 crore EBITDA loss that they were talking about in Raipur. Looks like some of the guys are like, they enjoy trying, so they're trying it on my screen. That's good. Then on the Mauritius, basically there is a hospital of 80 beds capacity. That hospital is not owned by Artemis. They only provide operational and management support. The entire profit and loss sits with the local management there, and Artemis gets certain amount of fee for each of the bed, and they're expected to grow that also there. I mean, I have not seen any concrete plans, but maybe it will happen over the next 1.5 years. But again, that won't really make too much of a difference to the PL and our balance sheet, because it's not owned by Artemis entirely. They just get the fees, which directly goes into PVT probably. Right, that's the overall picture. So one thing that I would like to highlight is that this hospital was actually started as a captive hospital by Apollo Tyres Group. Apollo Tyres has a pretty decent reputation, from the management and corporate governance point of view. So these guys started this for their own employees 20 years ago, and subsequently turned into a super specialty hospital. So that way they have a strong parentage there. And I was talking about JCI accreditation for any of the medical tourism related hospitals. So this is one of the first hospitals to get those in the Haryana region. And then obviously they have multiple other accreditations as well. So this is the revenue mix. Their top 4 areas are oncology, neuro, orthopedics, and cardiology. So all important cares. But obviously, being a super specialty, it supports practically every other key support that they need. And then, they get about 1/3 of their revenues from international patients, that MVT I was talking about. Then they get another 1/3 from insurance patients. And then, of course, the other 1/3 from the domestic cash and some of the government schemes that we typically see in most of the hospitals. So which is a pretty healthy distribution. Obviously, the government schemes related will add a bit more, debtor days and all, but I think it's manageable in the scheme of hospitals anyway. Okay, so one of the things that usually haunt me is I can't focus on any presentation if someone doesn't tell me what is the upside, right? I'm pretty sure many of you have a similar syndrome. So let's talk about what is the upside, and then we will talk about the, how they can reach there and what are the risks involved. So this is the blue sky scenario that we have painted. What we are imagining is by FY30, they will have all the operational beds available. Whatever that capex that I was talking about a couple of slides ago, about somewhere between 1900 to 2000 beds. And then if you take a blended ARPOB of around 81, 82K, and at an EBITDA margin of 24%. Right now, their EBITDA margin is 19% for the last quarter. And their EBITDA margin for FY25 was about 17%. So then, the question in your mind can be, hey, Shekhar, if it is 17% last year and they would barely touch it 19% now, how are you assuming 24%? Is because of the scale, right? So when I have certain lower number of beds, no matter how much I do, I can't reach the scale. So your operating leverage plays out when you have a scale, which is what they're building right now. So, and hence by FY 30, it is quite comfortable to assume that they will be in mid 20s. In fact, management guided for it. Why so? For example, while it is 19% margins that showed up on this quarter's results, Q2 results, the fact is it also includes some of the EBITDA losses from those 10 centers that we spoke about, right? So if I had removed those 10 centers from my pocket, then my EBITDA for Gurgaon facility might already be sitting at 2021, possibly. And then when I add 300 more beds and I operate them well, then I'm going to go up from 2021 to 24-25, right? So that's the simple math. And since we are talking about this 4 years ahead, so it is safe to assume 24% is what our blue sky scenario is. So when you assume 24%, then you apply 25x multiple for EBITDA multiple, then the market cap can be somewhere between 20 to 21 crores. And today on Screener, the market cap will show as around 4,500 crores. So that's the beautiful opportunity that we are envisioning. How much of this can happen? How much of this cannot happen? Let's now review. One important piece of information is the International Finance Corporation, one of the well-known fund houses. They had invested 330 crores. On Screener, if you open, it will show as if they bought this stake in the last 1-2 months. But the truth is they made this investment about a year and a half ago, sometime first half of last year. So that time the price was around that 170, 180. So they had taken the warrants that time, or debentures, whatever. And that got converted into equity recently in the last couple of months. And hence on the Screener, you will see as of these guys entered this hospital in the last couple of months, but that's not the case. Okay, so now the blue sky scenario that we are talking about, 4x to 5x returns, is it really practical, right? So let's talk about some of the things that can actually go wrong. So the number one thing is that the Raipur facility is a greenfield expansion, and then so would be the case with the South Delhi facility. So both of them are greenfield. Typically in greenfield, things can go wrong, right? I mean, if you don't execute well, or you run into delays before you could open up the hospital, then your margins will take too much pressure. And the fact that you would have taken certain debt to do the construction, that will add up the interest cost. So there's a ripple effect that will hurt. And we have seen this with many facilities in the past also, not only in the healthcare business, but even in the other industries as well. Whenever you expand using debt and then you are unable to manage that expansion well, then you want to see some serious trouble. So there is no exception for any company unless they execute it well. So that's one risk, obviously. Then the second risk is, like I was saying, these guys have one of the industry leading average revenue per bed. And hence, Supreme Court or central government at any point in time might look wrong way, right? And then say, oh, you guys have to cut it down. And then because of the fact that they have to invest quite a bit into the South Delhi facility where the construction is going to start early next year, there is a chance that equity dilution may happen. So they have raised about 330 crores from International Finance Corporation. They have about 40-50 crores cash on the books. So which is roughly some 390 to 400 crores is what they have. But the hospital construction, if you take a simple math of 650 beds of hospital construction, it might take anywhere between 750 to 850 crores. So there is a significant gap, right? Only they probably have 50% of the funding so far. How would they go for the other 50%? Would they go debt? Would they do some equity dilution? That we need to see. And those are the details management is saying they will come and share in the month of December, right? So if any one of you like this business, then December is a good month to watch out for, because some of those updates may define the how the stock price may behave, at least in the short term. And then, of course, the intensity is going up. In fact, some of the comments about Edarth Hospital, it went down about 8-9% yesterday, I think. And some of the comments were that, hey, very high competition, blah, blah, blah. But at the end of the day, people realized that management had done a block deal for onboarding a couple of institutions. But some of those comments that I was observing that, Edarth is now suddenly falling because there is too much of a competition. The reality is, yeah, competition is there, but there is a need also. I mean, that's a fact. And then management capability also we need to watch out for, because running one center and running it really well is one thing from running, three different centers. Down the line, couple of years, they'll be running three different centers, right? So how they're able to scale their bandwidth and how they're able to administrate it well. So some of those things we need to watch out for. While these are the risks, so let's see how these risks can be mitigated. So first thing, I went back into the history, right? So in MNCL, Monarch Network had done a coverage initiation on this hospital 3 years ago. And then if you look at that report, after they spoke to the management and whatnot, the management had said that that time they had about 340, rather, 390 hospital, 390 beds, less than 400. And that time they spoke about how they wanted to be a 750 to 800 beds capacity over the following 2-3 years. And today they have done it. 700 they already have. 300 more they can easily add in Gurgaon. And the Raipur is 300 is almost ready. Interiors are going up. So which basically means in the last 3 years, they have walked the talk, right? They were able to execute. And not only they executed, but they executed it with profitability. You look at the margins where they were 3 years ago when they had this ambition about, 750 to 800 beds. That time it was 12-13% to where it is today, 16-17% last year, and 19% it touched this quarter. And then Gurgaon facility should be comfortably touching 20 plus in the second half, although it may not show up on the result sheet because of the other expenses that they have. But the fact is they're able to do profitable growth, right? That's a good indication over the last 3 years. And hence it gives me confidence that in the next 3 years or so, they will be able to support and continue the same profitable growth. And likewise, 2023 annual report, where they were talking about, the Tower 2, Tower 3 in current Gurgaon facility. The current Gurgaon facility 3-4 years ago had only 200-250 beds, right? From there it went up to 390, then it went up to 570, then now it up to 700, so on and so forth. So this was one of the old report where they were talking about updates on multiple towers coming up in Gurgaon facility, as well as the 80-bed facility that they are supporting some local guys in Mauritius to set up, right? So all of this was not the case that time. It was still happening, and they have done it. Today they have that Mauritius facility is a successful facility. They get a lot of patients. By the way, one way that Mauritius facility is helping them is all the complex referrals from there, they directly go to Gurgaon facility. So they get a lot of patients from Mauritius. So again, they walked the talk, right? Whatever they have guided for in the past, they were able to execute. And who is the team? At the end of the day, it all comes down to the team, right? If you have a good management, the company will be successful. If you don't have good management, you might have short-term success, but long-term story may not be fun. So on that note, you look at the board of directors. You have Mr. Kanwar. He is from Apollo Tyres. I was saying Apollo Tyres is the parent group here. So a clean organization, good management. Devrina Chakravarti is the managing director, a doctor herself, and she also spent some time in the universities and other facilities, so that she has a broader and wider experience, right? Administrative experience as well as medical experience. And then, of course, some family members there. But on the bottom part of the chart, you see some prominent names. You see Vinod Rai, who is a former CAT, the gentleman who brought out this 2G scam and then coal scam, etc., 15 years ago, 15, 20 years ago. So he's a well-known guy for transparency and honesty. And then you have Ms. Pallavi and Mr. Akshay Kumar, who are managing partners at a law firm with a specialization in the compliance and litigation, etc. So you have that sort of a facility in the board. And then, of course, you also have another advocate from Supreme Court, Mr. Sanjeev Sain. So long story short, they have well-known management effort, especially if you look at tires company, right? Tires companies are well-known for cyclicality because of multiple reasons. So if you have a person like Mr. Kanwar who managed it and managed it well, then that kind of shows that they know how to run through good times and tough times and bad times. And then you have good finance and forensic presence in the board. You have a good legal compliance litigation presence in the board. So it's a well covered thing. So putting all this together, typically what helps in hospitals to operating leverage to play out, right? One, your capacity going up. Second, your margins going up. Third, your specialty mix going up. And fourth, you are attracting more and more foreign tourists, right, who are willing to spend more money. So in the case of Artemis, almost all of these are going to go well for them over the next 2 to 3 years. Matter of fact, for a lot of good hospitals, this is going to be the case, which is a fact. It's not just about Artemis. You look at any other good hospitals, they are probably going through a similar phase as well, right? So that's because it's a need. And then the fact that they are doing this in a very conscious way, very meticulously planned way. So this is an excerpt from the con call, the recent con call, where basically they are saying, hey, look, how we're going to focus is in the next 1.5 year, we will try to get our Raipur facility. Let me go back to this one to walk you through whatever the comments they have made. In the next 1.5 year, you can see my setup screen, right?
Yes, we can see.
Okay. So in the next 1.5 year, the Raipur facility will become profitable, right? Once it is profitable, then they will go to South Delhi. So what will happen is in the FY27, Raipur will start turning into EBITDA positive and whatnot. During that time, the construction of South Delhi would be happening. The construction of South Delhi will be completed by end of FY27, or I'm sorry, end of FY28, whatever. And by the time the Raipur facility will be sitting around 50K, sort of a ARPOB, making good money. And that gives them the flexibility to start operationalizing the South Delhi facility. Because for the construction, any which way they would have planned their budgets. So that's not going to have any negative impact. But where the negative impact could come is once this 650 bed facility goes operationalized in FY29, that will start bleeding because of the greenfield facility, that to such a large facility, it will have the negative EBITDA. To compensate it, both Gurgaon and Raipur would be running exceptionally well by that time, and that's how they are timing it, right? That's the timing. So it's not a random choice, rather they have planned it in such a fashion that they are not hurting the balance sheet, they are not hurting the P&L statement, and they are not hurting the EBITDA and EPS. So that's the kind of a dialogue that they have had in the recent con call. So it will be a good con call for you to read. And then I've captured some summary of key points out of the con call here. You could read this at your leisure later on, but I've covered most of those in a nutshell. And hence is why I have the confidence that if someone has the patience to hold on to this and keep accumulating whenever it gives opportunities at a lower levels, this could turn out to be a good wealth creator. So this is the peer view. So you look at Max Healthcare, one of the well-known hospitals, very expensive. They make good ARPOB of 75, 80K per bed. And then you look at, and their margins are about 25%. And what is the EV by EBITDA multiple that they have? 50 plus, right? Exceptional. Could that sustain? I have no idea, but that's where they are today. And likewise, you look at many other hospitals, except for Artemis and Indraprastha, everything else is sitting at 25 EV by EBITDA. That's a fact. Why? Because many of these hospitals have good scale. Where Artemis and Indraprastha, they have a limited scale. Now both of them are catching up with their scale. So Artemis, like I was saying, probably one of the best ARPOB. Their margins for the last year were about 16, 17%. But they have a aim to hit mid-20s in the next 3-4 years. And that's our main thesis. Bottom line is that when you have a 2000 bed hospital and you are doing a good blended ARPOV of 80,000 plus with the mid 20s margins, obviously the stock is not expected to trade at 22 EV by EBITDA on a trailing 12 months basis. It will be probably at 26, 27, 28. Let us see where it takes us. And hence, the opportunity that I personally see is twofold. One, there is going to be a growth where the bets are growing up from 700 to 2000 over the next 3.5 years. And then once they're able to settle down with all the operational challenges and they turn EBITDA positive and start creating operating leverage, then they will be able to get re-rating as well. And hence is why my thesis that it may hit 20,000 crore market cap. And if any one of you are thinking, hey Shekhar, why are you talking about Artemis? You should have spoken about Indraprastha, that is much cheaper. Yeah, absolutely. Indraprastha is a good hospital as well. In fact, I think Aditya Kemka spoke about this 3-4 months ago. But the reason why Indraprastha is probably available at a cheaper valuation right now and the price trend is downwards is because they got into a litigation recently. It's been a case that's burning, but it kind of heated up in the recent past. So they have a land lease agreement. According to the lease agreement, they are paying very peanuts as rent, but in turn, they are supposed to serve some 30 to 40% patients from the economically weaker section. That was the lease agreement that they had. So there was a litigation that was put on Indraprastha that they are not doing it. And recently, Supreme Court had sent some committee or something to hospital to verify. And in the verification process, they realized that it is actually true. They are supporting only about 10% economically weaker section instead of 30 to 40%. I think that kind of puts some pressure on the stock price because now you don't know which way Supreme Court may lead to. So it is still ongoing case. Last time I checked, I may not be tracking for the last couple of weeks, but there was the case earlier on. So it's a good hospital to track as well. To be honest, Indraprastha is on my watch list as well. But there is that legal headache, so I don't want to right now invest in it. I'll rather wait for the guidance and even buy it at 10-20% higher once the issue is resolved than trying to chase the price. Last slide. So this will be a good slide in case if you want to track this company. This will be a good slide to keep it handy, where I kind of try to capture the chronological order of how things may happen. So FY26 H2 will be better than H1. We already know it. It will be good. And FY27, there will be pressure from the Raipur facility in terms of margins because they won't have the 18 crore operational loss. And it can be more also. This is an estimate, right? You never know what can go wrong in a brand new facility. Sometimes, for example, let's say if one floor started leaking, there's a water jam or whatever, the whole floor goes unoperational for a couple of months until it's fixed. So any of things can happen, right? But the Gurgaon facility margins will start going up, but overall it may still not be visible because of the Raipur facility. And the construction work for South Delhi would have started well in next year. And then FY28, the Gurgaon facility should start coming up into playing the operating leverage role. So which is when you will have almost 1,000 beds from Gurgaon and about 300 beds from Raipur. So about 1,300 beds should be doing well, while the construction for Gurgaon facility should be about to be completed. FY29, Gurgaon facility will be good, Raipur facility will be good, South Delhi facility will run into margin pressure because of the fact that that is its first full year of operations. And FY30 should be a golden year where you have a 650 bed of South Delhi facility where the ARPOB can be better than the Gurgaon, by the way, because South Delhi is even more premium. So you will end up two high premium hospitals in the neighborhood with about 1,1700 beds between them. And they are chasing a 95K. I mean, I've estimated 90K as the ARPOB, but the truth is it will be much more than 90, truth to be told. But I'm being conservative. I just stopped at 90, but it could even cross 5 digits, right? So that's the kind of a scenario. So what this means from the stock price point of view, it may give some opportunities over the next 6 to 8 months, especially once the Raipur facility comes up, and it should give again one more opportunity in FY29. One more opportunity doesn't mean in FY29 the stock price will come all the way down to 270, 280. No, obviously it will consolidate at that level wherever it is that point in time. But if someone has the stomach to hold this, should be a good play, is my sense. So that's the the truth. If it is a worst case scenario, so maybe the facility is coming up slowly. They are not making as much as they should have. It could be just about 10, 11,000 market cap. Vis-a-vis, if they're able to execute well, it could be a 20,000 crore market cap. So let me end the story here. If there are any questions, happy to answer.
Great. I think you have done a quite justice to this presentation, actually, quite detailed. Even I was accumulating this, but did not go to too much detail about this. I think the few of the questions is on the pledging of the promoters. I think we need to track that. But if you have any other inputs on that,
No specific. Yeah, I think those are all common, yeah, in my
yeah,
opinion. And I think the management is a good management. The first thing that in hospitals, which is very important, is the management credibility. So here, that is one of the reasons actually it attracted me to this hospital. So I think as long as management is good, they have clean history. You search in Google, in any cases against Apollo Tires Management or Artemis, you won't find any. So I think this pledging or debt, etc., they are part and parcel of the game. I won't read too much into it.
for doing this market cap in 2030, I think you have taken 82K till that time, right? For
Yeah.
market cap. Okay. So if somebody has a question, right, if 82K is sustainable or not, you need to put inflation also into picture and think of this 82 might go to 1 lakh in Delhi and Gurgaon kind of stuff by 2030. And with Raipur also coming up to 50, 60, I think 82 would be a good estimation with that. I think this
Yes.
one question might come.
Yeah, absolutely. I think you kind of read my mind, Puneet Bhai. So that's the same thing I've gone through. So like I was saying, 90K is conservative for me because what is going to happen to Gurgaon facilities next year itself, they will cross 85. So forget about FY30. Next year itself, they'll cross 85. And then the year later, they might be touching 90. So FY28 itself, Gurgaon might be 90. But I just wanted to be a little more conservative that let's be a bit pessimistic. We shouldn't get too excited because
Yeah.
not everything will go right. I mean, some things will go wrong.
Yes. And if you take the names, right, big names, Apollo, Max, Fortis, apart from that, no big names possibly in the big regions. And if Artemis can fill that gap in those kind of regions, I think a lot of they can generate out of this.
Yeah, absolutely. In fact, while the Daffodil and Artemis Light and Cardiac Care, while some of this 10 centers, they are not really helping the bottom line. What they are helping, which is again a conscious effort from the management, is they're creating the brand.
Mhm.
Right, so they have set up them in multiple areas, so they are creating the brand, they're establishing the brand, and hence tomorrow when the South Delhi facility is coming up, it's not a brand new thing. From the branding point of view, people know about it, so that's the advantage that they have. And although, yeah, so there is obviously enough competition in Delhi and Gurgaon region, but the truth to be told, that's where most of the MET patients also come. Most of the medical tourists, they actually end up reaching to Delhi, not to majority of other cities. So that way there is enough influx. Plus, I mean, honestly, the number of beds we have or the number of beds we're going to get in the next 5 years is not sufficient enough. In fact, there is one slide that I have taken the liberty of copying from Aditya Kemkas ji. Look at the number of beds here. I mean, between all these specialty hospitals. This is nothing. 65, 70,000 beds in the next 2, 3 years, that is peanuts.
Yeah.
You would have need of lakhs of beds in the super specialty. I mean, this is not the whole set of India, obviously. This is super specialty. But we need a lot more super specialty. I mean, look at one IT company. One IT company has probably a few lakh employees working in India. Look, and then you start counting the number of beds. They are very few. So I don't think competition should be a challenge. The only reason why Artemis may not do well for that FY30 blue sky zone is because they did not execute well, is because they have made some surgeries a mess where there are complaints and litigations and there is a bad media and all. Those are the risks. I don't see competition as a key risk.
Yes. Okay. Yeah. Any other questions from participants, listeners? Please, you can ask.
Everybody is fell asleep, I guess.
No, I think I covered some part of it which people have mentioned.
Okay, excellent. If there are no questions, feel free to ping me on Twitter as well in case if you have any additional input. Again, these sessions are about learning from each other. So if you have something more that you know about this hospital, I would love to learn from any one of you. So, but otherwise, a good hospital to track. In fact, good sector to track. Which hospital each one of us are comfortable with is a personal choice, but good sector to track. So with that, thank you, Puneet Bhai, again for having me here.
Yeah. Thanks for your presentation as always. Very, very crisp and convincing.
Shekharji, just as Ramakrishna asked, why is Kerala government having stake in this company?
I have no idea, to be honest.
Because the whole concentration is towards, if it is towards Delhi, then why would the Kerala government invest?
Yeah, that's a good question. Maybe I'll try to do some Googling and share the answer back. But I think Kerala government does have investments in few other companies as well. It'll be interesting to know what's the strategy that they had.
Okay, sure. Thank you.
Thank you.
Okay, so
Hi, I have one question actually.
yeah.
So if the group keeps building one hospital after another, like you said, Raipur and then Delhi, so like until 2030, if there is no meaningful bottom line revenue, then as an investor, how much of a juice is left for the investor then? I'm just curious.
Yeah. So no, there is a meaningful growth in the bottom line as well. So I think, see, imagine this way. The Gurgaon facility today has about 82K ARPOB, right? So that is going to touch 85, 86K next year. And then on the top of it, the 700 beds will start becoming 800 beds, 820 beds, 850 beds, so on and so forth. So the Gurgaon
Okay.
facility is growing, which is going to add very meaningful bottom line because the margins are going up there. And then the 10 clinical facilities that they have, the cardiac care, light and daffodils, whatever, there the EBITDA negative is stopping now. So which means that thing will be added to the PAT directly because by cutting the loss, you are actually becoming profitable. And
Okay.
then in the Raipur facility is where in FY27, you will see 18 crores operational loss, which management believes that will be compensated because the losses that I was incurring in my other facilities are now cutting down. And hence I will be able to absorb some of that 18 crore loss from the Raipur facility. But otherwise, the Gurgaon will continue to grow. And I think the EPS point of view, FY27 should be better than FY26. But the operating leverage won't play out. So the operating leverage will play out in FY28 once they have the 300 beds are fully operational and fully occupied. So that's when the story starts much better. And hence, yeah, one way to look at it is if I'm a technical trader, I might wait for the FY27 at some stage and then start jumping in, etc. That is one way of doing it. But if I'm a fundamental investor, and especially in my case, I want to play this theme for next 5-7 years. And hence, I'm not going to put all my capital on day one. But if, like I was saying on the slide as well, right, FY27 may give some opportunities. But those opportunities will bring the stock price down to 270, 260, or by the time the stock price would have gone to 370, 400, and hence the consolidation may happen at a 350. That I don't know. That I can't anticipate, right? So that's why we'll have to, if at all I'm going to buy this, I'm going to buy in a tranche-based approach in the next 1 year.
Okay. Got it. Yeah. Thanks.
Sure.
Okay, I think we can stop here and take a pause for 10 minutes break for the people as well. Thank you, Shekharji, for wonderful presentation once again.
Thank you, Puneet. Bye.
Yeah,
Bye.
so we will close the session and we will restart the session in 10 minutes from here. So please, everybody has to rejoin back just to keep our videos short. Instead of 4 hours, it will be 2 hours. Okay, yeah, we'll meet in 10 minutes. Thank you all.